Hey guys, Broke Investor here. Here to talk about options trading. Um, Obviously, all of my videos previous to this have been focused on dividend investing primarily. And lately, I've been getting involved with options trading. I know it has trading in the name, so it's already scary, with that alone. Not to mention the options being in the name is also intimidating. For the first couple years, whenever I heard options at all, I just shrugged my shoulders and moved on. I said, not for me, too risky, I'm not getting involved. And then eventually, 3 years down the road, I decided, you know, let me at least learn what the hell it is. Because if you're going to be an investor, you need to understand all aspects of investing. And that's whether or not you're participating, in that type of investing. So it's good to be well-rounded, when it comes to investing your own money. Because, you don't want to lose your own money. You want to be smart about your money, and you want to take advantage of all opportunities with your money. So I dug deep. I learned about options trading, and long story short, I was very impressed. I was completely proved wrong because honestly, it's not as risky as you think. And part of options trading strategies, honestly, they go hand in hand with dividend investing, or they can. So what I'm going to do today is I'm just going to explain how to do a particular trade, we'll call it, in options, mainly selling puts. And I'll go over, a put that I sold actually this week. So hopefully that, it makes sense for everyone. And as always, I'm not a financial advisor. I'm just a broke-ass investor. So, do your own research before you actually take any risk yourself. So anyway, let's get started. As you can see from the screen, I have a stock up that's called Telephone and Data Systems. So when it comes to options trading, first thing I'll say is you want to do, a contract on a stock that you trust. So don't do anything with options on a stock that you would not normally invest in. So don't be playing around with penny stocks. You didn't buy them to begin with, so why would you do options with them? So, I would play around with companies that you're familiar with as is, companies you already invest in, companies you're willing to hold long term. Now, that being said, TDS is a company that I wasn't previously involved with. However, options actually opened my horizon, and I did look into many, many more companies that may have not met my dividend investing long-term criteria, but may have met the criteria that I need for an options trade. So, long story short, TDS is a company I trust. So, how do you do an options trade? First off, obviously I have Robinhood up. And by the way, for those of you that keep knocking Robinhood, well, you're probably not even watching this video because you hate Robinhood so much. But I just, the hate is just unbearable. I just don't understand it. I mean, I get it. There's a lot, some of the brokers have been well established for many years. Fidelity, Merrill Edge, TD Ameritrade, whatever. Charles Schwab. But automatically, if someone uses Robinhood, people assume they don't know shit. They're a rookie, they're dumb, they don't know what they're doing. So I have constantly kind of argue with people about this because I still use Robinhood. I'm about 3 years in to investing in general, but the reason I got into investing is because Robinhood was available at the time, offering commission-free trades. And I don't want to go off on a tangent, but anyway, I like Robinhood. I like the interface. The app is great. I use other apps. I use Fidelity. I use Merrill Edge. their apps aren't as good, honestly. They may have more data available for the website, but I just like the interface on Robinhood. Anyway, let's get back to it. So if you use Robinhood, or any brokerage for that matter, and you want to start getting involved with options, you have to apply for it through your brokerage. Because when you open up a brokerage account, the normal setup will not include options trading. You have to apply for different levels. Typically, I believe level 2 or level 3 is what you would apply for to get the basics of options trading. So anyway, once you apply for that and they approve you, which, it doesn't take much, then you can play around. So in Robinhood, all you have to do is when you pull up the stock, you go to trade, and normally it would just say buy or sell if you owned it, but now it would come up trade options. So what you would do is you would select trade options. And this brings up a whole new screen that is probably foreign to everyone. So let's go over, some of the basics. So obviously it'll show the ticker symbol at the top, and then below it, it'll show what you're doing. So there's buy or sell, and then there's call or put. So you can buy a call, you can buy a put, or you can sell a call and sell a put. Right below that are different expiration dates, because when you sign up for an options contract, there has to be an end date. So you can choose an end date. In this example, they have monthly contracts. So December's expires 18th, which is next Friday, and then after that, it's January 15th, so on and so forth. So you can choose how long you want your options contract to go. And then below that, we'll show all different information, prices, mainly the large amount in white next to, and again, I'll pull up sell put for now. The large amount is called the strike price. This is the amount that you're willing to either buy or sell the stock at for, as of a specific expiration date. Now again, for this video, I'm mainly going to cover selling puts. So let's cover that now. So TDS has a current stock price in the middle. As you can see, share price shows 1908. So that's the current price. When you say sell a put, what this means is you are willing to buy the stock at the strike price listed. Now, if you look at, let's show $15 put. Now, as the seller of the put, if you're willing to buy the stock for $15, which is way below the current share price, then you'd get 1 penny per share, and each contract is 100 shares, so you'd get $1. As the seller, $1 is not worth your time, obviously, because the further away you go from the money, from the share price, the less premium, when you're selling a put. Because again, when you sell a put, you have to commit to buy this particular stock at a particular price, up until the expiration date. So on what I have on the screen, as you can see, there's a 1750 put, and it has a -1. That means I already have a contract. I have one contract. So what I already did, I sold a put with a 1750 strike price. So at the time that I did it, which was 2 days ago, actually, the 10 cents that you see to the right in the box, that's the premium, that was 15 cents. So what I did was I committed to, I sold a put, 1750 strike price, expiration December 18th. So I basically said, I'm willing to pay $17.50 a share for 15 cents per share in premium. So when I, committed to that contract, I got $15. Now, before committing, you have to make sure that you have collateral for the funds, because 1715 times 100 shares is $1,750. So Robinhood's not just going to say, okay, you know, he's good for the money. They're going to either make you post the collateral or open a margin account. A margin account is basically like an equity line. It's essentially like a line of credit, which I would not recommend. So many people recommend it, but the way I look at it, if you don't have the money to gamble or invest, whatever you want to call it, then don't bother. I'd rather only invest and, take the risk with actual money that I have, not something I'm, borrowing. Because if something bad happens, then I have to pay them back. Then I'm essentially in debt. Robinhood as the creditor. So I don't need that. So I had the 1750 in my account. So when I sold this put, they took that money and they're holding it as collateral. And the reason they're holding it is if the share price goes from the 1908 to below 1750 or the break even of 1740, then I am assigned the shares and I have to buy 100 shares of TDS at 1750. And that's regardless of the current share price. So the stock could go down to $15, but I still then have to buy it at 1750. So why would I do this? Why would I be a seller of a put? Why would I bother? And the reasons are, number one, you would be willing to invest in this company anyway. So buying 100 shares of this company, doesn't bother you. Obviously, you want to choose a price that you're comfortable with. And number two is the premium. So again, in the boxes to the right, there's a number, and that's the premium per share. So basically times that by 100, and that's what you'd get per contract. So as, selling puts, you can get paid to essentially possibly buy shares. If the expiration date comes on December 18th and the share price is still above 1750, then guess what? I get my collateral back, and I also still keep the $15 that I got up front. There is also the possibility that you can buy back your put early, assuming you had earned the most of the premium up front already. Because again, you're doing this for the premium mainly. So if say I get $10 or $12 within the first week, this week, then I'll buy it out. So essentially, I'll take the $12, I'll pay $3 for the put, and so I'll buy the put and then I'll move on with my life, and then I'll use that 1750 collateral elsewhere, and I'll sell additional puts for additional premium. So I hope that made sense. Now, I just want to show a few things. So if you go above the share price, if you're willing to pay $20 for the stock, up to an expiration of December 18th, you get $1.15 per share, which is $115 for 100 shares. That's a lot of money. However, why would you be willing to pay more than the current share price? Because God forbid this, the stock price does not go up. It either stays where it is or goes down. You're going to be stuck holding a stock at a loss. So that's why these premiums are so much money. The higher the strike price, the more in premium. Look at the $35 put. You can get $1,625 if you're willing to buy this stock at $35. However, this is priced, like car dealerships. It's priced so they can make money. The buyers are not getting ripped off here in this example. So I just wanted to show that. And another thing, the further you go out in expiration, the longer you're able to commit, the higher the premium. So that same 1750 put, if I said, okay, I'll go to January 15th. I'm willing to pay $17.50 up until January 15th. Then they'll give me 35 cents per share, which is, again, $35. If I say, okay, I'll go to February, they'll give me 75 cents per share, which is $75. So it all depends, what you want to do. And again, there's different strategies. I've been working on weekly puts. This is a monthly. This one does not offer weekly. This one offers monthly only. So obviously this put I had to commit for, it's a little under 2 weeks, which is fine because this is a stock I trust and everything else has been up lately. So I'm not trying to, get completely ripped off here. But anyway, so yeah, when you sell a put, you can get paid premium for putting up collateral for the possibility of buying shares at a particular price by a certain date. Now, this seems like, when I learned this, it seemed like too good to be true. Why would someone pay me money to buy stocks? And I'll explain the buy side briefly. And the buy side is, if you click buy, so you can buy this put, the same 1750 put today for 10 cents per share, again, which is $10. Now, why would you do that? Why would you be a buyer in this transaction? Why would you want to pay premium? And there's really one reason, and it's called insurance. People, it's called shorting as well. So if you think this stock is going to go down, and you want to protect yourself from losses, buying a put is essentially one way to protect yourself. So if you bought this put at $17.50 and the stock tanks, and by December 18th it's $15, you still can sell these stocks for $17.50, which if it went down to $15, you would. And then the seller of the put, which was the transaction we spoke of before, is paying the $17.50. So you're not at the loss of $15, but you only lost the difference from 1908 to 1750. So again, the buyers are more so for insurance, the buyer of the put. Now, let's talk about what would happen if the transaction went through. So if I sold this put 1750 and on December 18th, the stock price is, let's just say $17. Okay. So I now own these shares. I own 100 shares of TDS at $17.50 and the stock is at $17. What the hell do I do now? So the other strategy is selling calls. So on the flip side, you make premium selling puts, and on the other side, you can make premium selling calls. So how does that work? So that works by, you can sell the stock. Keep in mind, you owned 100 shares of this stock at $17.50. Now, you can sell these stocks for profit if it goes above $17.50 yourself, or you can say, okay, I'm going to sell these shares for this price by this date. Now, so in the example here, you can sell a $20 call. You can sell this stock for $20 by December 18th, but you're going to get no premium. You're going to get 1 penny per share, $1. However, if you sell it for $17.50, which is below, obviously, the share price, the premium's high. So what you'd want to do is you'd want to pick a strike price that's either equal to what you paid or greater. Keep in mind you got premium. So if you sell it for the equal amount that you paid for it, you're still up. However, you may want to take additional advantage of capital gains. So should you own, again, the stocks that for $17.50 and you obviously you want to make a profit, then you can wait and sell a call for $20, but you're not going to get much premium. So if you're willing to let this go for no capital gains and just continue to accept premiums back and forth, then that's the route to go. That's my plan. I have not been assigned yet. I've sold many puts, but I have not been assigned. But the plan is, for example, for TDS, if I do get assigned and I have to buy it at $17.50, I would be willing to sell a call for $17.50 because again, I got the $15 premium I mentioned before, and then I'll get additional premium for selling a call for $17.50. So I'll be up in premium alone, but the stock price in general will be a wash. Now, why, again, selling a call, you're getting a premium. Who is paying you this premium? Why would someone buy a call? So it's kind of reverse what we spoke of earlier, buying puts. So when you buy a put, you're bearish. When you buy a call, you're bullish. So this person, if they're willing to say, pay you a premium of whatever for the $20 call, they'll pay you 1 penny per share or $1, and they'll pay you that for the possibility that this stock will go above $20 per share by expiration date. So this is, for the people that want to get rich, they want to get rich quick and they can't afford the stocks. Like they can't afford to just buy Tesla outright. They could buy calls and they could say, okay, Tesla is going to go above this price by this date. And they could do that and pay someone a premium for the possibility, However, in this example, obviously, they're paying, based on the current share price, they're not going to be many calls, because this stock does not move much. So you're not going to get rich on TDS. So there aren't many contracts that buyers want. There aren't many calls to buy except below the share price, obviously, because then they could buy it for lower than the current share price. So this is more for speculative stocks, buying calls. It's also, options in general. It's more so for high volume stocks, which means a lot of activity flowing in and out of those stocks. And the higher the volume, the higher the premium, because obviously they're more volatile. So that's the other thing. Now, I mentioned I did do a put before. So I just wanted to show you guys what it actually looks like. When you pull up the stock, you can see I have one options contract, which now has a value of $10. So I did earn $5 to date. So I can buy this contract. I can buy myself out for $5. And I would keep, I'd pay $5, so I'd keep, essentially the $5. I'm sorry, I'd buy it for the contract for $10 and I'd keep the $5. And because as you can see, this contract, it's now worth, value of $10. So total return $5, which is 33% of the contract. If today this goes up to plus $10, which would be 66%, then I'd probably buy it out, which, I can explain it in a later video. Now I can actually select the put, and this will just show you where it's at. You could see it was at 15 cents, and then it went down to 13 cents. It went down to a penny. I don't know how that happens, but I tried to jump in on that yesterday. It didn't work. So this is inaccurate here, this line. I don't know what's going on there. But now it's back at 10 cents. So this contract is worth 10 cents per share. So that's where I'm at, and that's what I'm doing. So to date, I've been doing pretty good with my options trading. I've been selling mainly puts. I have not been assigned, so I have not really sold a call yet. But I plan to. I plan to go back and forth. And this method there's a term for it. It's called the wheel strategy. I know I'm not doing exactly that, but the idea is the same. So if you just Google wheel strategy, you can see exactly what to do and different methods. There's many groups on Facebook, and there's different chats, and it's good to hear different opinions. Some people, on the buy side, in my opinion, I don't bother with that. I'm never going to buy ever. It's not for me. It's high risk. low, high risk, high reward, because I don't want to pay a premium. I don't want money leaving my pocket. I want income. So I'm the seller. I want income. I want additional income on top of my dividends. And again, another strategy for this, you could sell a put with an expiration date that's right before the ex-dividend date. So, and the reason you would do that is to capture, you would want, say you'd want to get assigned, you'd want to choose a strike price that's closer to the share price, hoping you get assigned, because then you'll collect the dividend. And then sell the call. And then you can give someone else the shares and then do another put. But however, you sell the puts until you get assigned, or you sell the calls until you get assigned, until it gets assigned to someone else. So that's it. And as I learn, I'll keep sharing more and more. It's pretty damn simple, if you ask me. And it's just another way to make additional income on top of dividends. And to me, it's very safe. But again, it all depends on the stock you choose. Just like dividend investing, your money's just sitting there in the stock. Anything can happen. It can go bankrupt. Similar here. You could be selling a put for this price, and the company can go bankrupt, and you still have to buy it for the strike price. So the risks are all the same. It's basically the same strategy when it comes to this, at least the way I look at it, because I'm willing to buy and hold forever, these companies. More so, the dividend stocks I own are buy and hold forever. Option stocks, I consider them buy and hold for now. I'm trying to keep them separate, and they also, again, have different criteria to qualify. So anyway, I hope this helped a lot of people. I know people did like what I shared on my Instagram, which, again, I'm the _broke_investor, I believe, on Instagram. I have stories that kind of go through the exact step-by-step, which did help a lot of people. So I made this in follow-up to that. So sometimes hearing it is a little better for some people. But I hope this did help, a lot of people out. But please leave a comment if it did. Please leave a comment if it didn't. And click like regardless, and that would help my channel out greatly. Obviously, I'm looking for some more subscribers so I can make more videos, more content. I just mean, it helps for the motivation too. So if you did like this video, please share the YouTube. Please share it with your friends. Please share it with whatever, or just like and comment, and that's good enough. But anyway, again, I'm the broke investor, not a financial advisor, just a broke ass investor like you guys. But one day, we shall retire based on on our investments alone. Anyway, guys, I'm out. Time to go to work. Later.